Your market news now. Most emerging Asian stocks edged lower as the risk rally fueled by the Federal Reserve's dovish turn lost steam ahead of the release of key U.S. economic data. All three major U.S. stock indices yesterday, which were at or near record highs this week, veered lower late in the session. Meanwhile, oil prices steadied with Brent trading near $80 a barrel as higher inventories and record output in the United States overshadowed jitters over global trade disruptions in the Red Sea. For shipping, about 12% of world traffic passes up the Red Sea and through the Suez Canal. However, analysts say that the impact on oil supply has been limited because the bulk of Middle East crude is exported via the Strait of Hormuz. To talk to us a bit more about the markets, we are joined by Warwick Lucas, who is from Galileo Securities. Warwick, thank you so much for your time this afternoon. And I'm wondering whether your festive look right now is any indication on market sentiment.
Yes, Tash, I think overall global market sentiment is really quite positive. We've seen expectations for GDP growth in the US are lower, but still positive, which keeps the risk of prospective inflation quite low, but without tanking the economy either. And in addition, the last CPI print we saw headed in the right direction as well. You know, there's a well-known January effect, which is actually, since it was so anticipated, moved into December now. Perhaps that's distorted the numbers, but I think it's a good finish to the year.
I mean, when you look at the local markets so far for 2023, the year's not quite over yet, but what's your assessment of the performance if you look back at the past, say, 11 months?
Okay, so I think locally we were quite subdued, a very long sideways move, one of the quietest years in many ways that I've seen, but that was despite a really quite considerable deal of important news flow. And I think we saw a series of offsets, I suppose. I mean, we had the local GDP really was quite weak due to the SOE problems, Eskoms and water and so on. And the Rand struggle with these issues, but the same token, the weak Rand is supportive of our local market. We've had flat commodity prices. That was also an issue. Local interest rates very high, had to be restrictive to keep a lid on inflation. But the good news is that the stern tone that was adopted by the finance minister with regard to the state of government finances actually had quite a good impact, first of all, on our so-called credit default swap rates, and we've seen that coming through in our bond markets as well. So it's really good for restoring some credibility in SA.
We've been talking about the Fed pivot, and I'm wondering what that means for you as an investor. What are you taking from this?
So the key issue as to the next actions of the Fed is really whether or not enough has been done to rein in inflation. Now, growth was robust last year, but it's slowing, and we're seeing new job openings in the US sharply falling off. So this suggests really that the Fed, I think, is in a position to be accommodative in the new year.
Right. So, I mean, let's talk about that new year. What's your base case for 2024?
Right. Base case for 2024, I think global markets sort of look okay with the interest rate cycle peaking out in the US. It's a debate whether the economy will recess. My view is it'll be quite slow, but no face plant either. In South Africa, the economy might see some relief off the low base set by the 2023 load shedding, but low growth, low confidence, high interest rates mean basically go for quality and for big caps, no small cap punting. And really also watch the sluggishness in the Chinese economy. I mean, it could take quite a while before a commodity recovery shows up there. So with that in mind, then the base case for the Rand is probably around about neutral at the moment.
With that said, what are some of the risks that you're going to be paying attention to, whether it's local or even, global?
Look, I think we've got to watch out for surprises, and I mean 2023 it was full of surprises. You know, if I looked at the forecasts for the big three economies, I mean basically all of them were out. So surprises are always there. You've always got to plan your investing around how resilient are you against surprises.
Let's talk about some of those calls that we made coming into 2023, because the recession call was the number one, and especially in the US. What else in terms of market calls caught your attention, and where are we with those?
Absolutely. The recession call in the US was obviously the big one that went, that really didn't go anywhere. I think the other big call was, of course, the much mooted post-COVID recovery looked for in China, and we just didn't see it show up at all. I think part of that is that Chinese monetary policy, I think, is probably in the wrong place. But I referred to the big three world economies. I mean, we saw quite a nice little trot going on in the Japanese economy, and I think that was a big plus because it offset some of the negativity that we saw in China. So, yeah, they were quite wide, those forecast errors. Yeah.
Let's talk a bit about the market expectations for rate cuts versus the Fed's expectations. Do you see us ever narrowing that spread or being at a point where the market and the Fed are on the same page?
I think we are probably going to lag the Fed for a while. I think the Fed's sort of current state is an important input into our own policy making, and yeah, I mean we've got to see our own interest and government economic policies coming through and really delivering on the year. I mean, that's really something that's been quite weak, but coming back to the fore and improving towards year end there.
As we wrap up earnings season in the US for January, how high is the bar?
Okay, so the estimated earnings growth for the S&P 500 is about 2.4%. For quarter four, I think we've got about 72 S&P 500 companies issuing negative earnings per share guidance and about 39 that are indicating positive. So all in all, this suggests that markets are quite well positioned or cushioned against any negative outcomes. So, yeah, we see negative outcomes. I think the market will just shrug it off and move on. We've got to see quite a train smash before things turn tail for the worse.
Warwick, thank you so much for your time. Have a happy Christmas. That is Warwick Lucas, who is from Galileo Securities. And today we are looking out for US GDP data. Tomorrow we've got data coming out of the UK looking at GDP. The Bank of Japan's November minutes will be coming out, as well as the inflation data, which will give us an indication in terms of where we are going when it comes to their interest rate decisions. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.